Hello and welcome to another insightful edition of Market Views, your deep dive into Zimbabwe's capital markets. We break down market performance, unpack key developments, and provide our analysis to help you in your decision-making process. I'm your host, Kudakwash Taimo, and in this first segment, I'll walk you through the weekly review. Let's get started. Over the past week, the ZSE All-Share Index rose by 0.63%, partially reversing the 2.68% decline which was recorded in the prior week. The gains were largely driven by the medium cap index, which advanced by close to 2%, while the top 15 index increased by 0.59% and the top 10 index added 0.39%. Market breadth was positive, with 17 counters closing in the green and 10 counters in the red. On the VFX, the All-Share Index gained by 0.5%, extending last week's 4% rally, supported by 9 counters closing in the green against 3 laggards. In terms of market activity, the turnover on the ZSE rose sharply to 649 million ZiG from 201 million ZiG, recorded in the previous week. Meanwhile, activity on the VFX softened, with turnover declining from 4.9 million to 4.1 million. Let's now turn to the counters that dominated trading activity on both exchanges. On the ZSE, Econet led the turnover board, contributing 45% of weekly turnover at 293 million ZiG, compared to 71% at 143 million ZiG, recorded in the previous week. Hippo followed, accounting to 29% of the turnover at 187 million ZiG, while Delta contributed 21%. On the VFX, Innscor remained the dominant counter, accounting for 64% of total turnover at 2.6 million, marginally down from 66% at 3.3 million in the previous week. Padenga reigned second, contributing 27% of turnover at 1.1 million, maintaining its second position. Last week, it accounted for 20% of activity at 977,000 USD. Let's look at the major movers and shakers over the week. Fidelity Life emerged as the top performer, trailed by Tangana, following a full subscription of 8 million rights offer, with 45.66% taken up by shareholders and the balance under-retained by Rutani Beverages. Other notable gainers within the top 5 included CFI, CBZ, T and Cybertech. On the downside, FBC led the laggards, followed by TSL, Marshall Holdings, ZSE Holdings and ProPlastics. Mashonaland Holdings released its financial results for the year ending 31 December 2025, with the bottom line up by 4%. Do check those results if you haven't. Turning to the VFX, Citco International led the gainers, trailed by African Sun, following a 99.99% shareholder approval on the 18th of March for its delisting from the VFX. Axia was the third gainer, and as we have seen, the counter declared an interim dividend of 0.2 US cents, which equates to around 2.7% dividend yield, which is likely to be paid on 17 April. Padenga was also marginally up amid ongoing US, Israel and Iran geopolitical conflicts. On the downside, Kavango Resources led the laggards. It shared 39%, further aiding to the 13% decline, which was recorded last week. Let's look at the market cap rankings. The decline in Hippo's share price over the week ending 13 March resulted in its exit from the ZSE top 10 by market cap, with AFDIS replacing it. Otherwise, other counters on the ZSE rankings were largely unchanged. On the VFX, Padenga overtook Innscor to become the largest counter by market cap in the week ending 13 March, and it has maintained its position up to now. And this is supported by the reset commodity price tailwinds. Looking at valuations, Delta is the most notable counter by market cap on the ZSE of approximately 1.12 billion, and it's broadly aligned with this 2021 peak of around 1 billion. However, it remains slightly below its 2014-2013 range, whereby in 2014 it had 1.27 billion and in 2013 1.7 billion. Econet's trajectory, on the other hand, has exhibited a more event-driven recovery. The counter rallied strongly on the back of the delisting narrative and the recent dividend in its Q4 for the year ending February 2026. And together, this lifted the market cap to approximately 935.5 million, a significant rebound from the 2022 to 2024 trough range of around 241 million and 304 million. Despite this recovery, it continues to trade slightly below its 2021 peak valuation of 1.1 billion and remain under management implied valuation of approximately 1.5 billion, anchored on the 50 cents share floor price. And at current levels, it offers a dividend of around 8%. Now, that's all that we have for you for the first segment. Thank you for tuning in. Let's touch base on the second segment. Welcome to our second segment, where we unpack the financials of our listed counters. And today it's quite interesting because we're looking at Innscor's half-year financials as well as Axia's half-year financials. And like usual, I'm joined by capable analysts that I'm going to discuss with some of these financials. And to my left, I have Ian Banda, and to my right, I have Chabulani. So, gents, welcome on set.
Thank you.
It's a pleasure to be here.
Okay, let's get started. Let's look at Innscor firstly. And I'll start with you, Jabu. Revenue surged by 19%, but profitability, it grew at a faster pace than revenue. It grew by 64%. I would like to hear your views. What were the primary drivers of this bottom line growth which outpaced revenue?
Yeah, it's an interesting happening that we see there, where revenue grew but cost did not grow at the same rate. Because if you look for the past 3 or 4 years, Innscor was on an overdrive of capex. We saw over 100 million in and around their factories and other things that they use to produce their goods, like logistics, admin, were already in place before. So this was a planned type of growth where they put a lot of money, and now it was time to reap that the economies of scale. So every dollar of sales dropped into profit because the base was there.
Okay, let's look at the margins. Yeah, we saw the EBITDA margin improving from 11 to 12.6%. What were the key drivers of this improvement?
Okay, thank you, Kuda. So we saw that is a 160 basis points improvement in the EBITDA margin. I think this was brought about by production efficiencies in a way that they, like Javlan attributed, they invested a lot in automation. We saw that they brought on new lines of production in the bread making unit, that is their bakers in. So these efficiencies resulted in the EBITDA margin improving. And also we noticed in the financial statements that they released that they were talking about most of their business units operating almost at full capacity. So you see that the fixed cost per unit, sort of cost absorption, is reduced because you're now producing at a larger scale.
Thank you for that. Jabu, we know Innscor is about 3 main SBUs. That's the beverages and other light manufacturing, the milk bake segment and the protein segment. Which segments were the key drivers of the margin expansion?
The key drivers were in protein, bakeries, and light manufacturing, where scale benefits were seen. That was where most of the gain was in. Like the protein, we are looking at chicken and stock feeds, and the bakeries and consumer staples. Like we know, bread is a key component that people buy daily. So we saw most gains there.
Okay. Ian, let's look at the cash conversion ratio of Innscor. What is the current cash conversion ratio and how does it compare historically?
So the current cash conversion ratio, by cash conversion, maybe to just help our retail investors.
Yes.
When you speak in technical terms,
Oh.
it might fly over most of them. So
Sure.
we're just saying cash generated by operations in comparison with our EBITDA margin. So this is the ratio. So in half year 2026, we saw that it was around 105%. Then if you look at half year 2025, it was around 116%, somewhere there. And if you look at full year 2025, we had around 180%. So this is just showing us that this revenue is being, in fact, the profit is being translated into cash. It's something that is tangible. Yeah, and the business is in very good health.
All right, thank you. Jabu,
Yes.
I'll ask you this question. Return on asset was 6%. And one might need to know whether this is something that's quite significant considering the size of the group. But I'll also add another question. Looking at the balance sheet, the liabilities, they grew by 16% and equities by 9%. Is it a cause for concern, this slight increase in liabilities, which outpaced the way the equities grow? So I'll pose those two questions too.
All right. So on return on assets, we have a 6%, which is good but not exceptional. But when we factor in things like currency risk and policy risk in Zimbabwe, and some of the headwinds like taxation and so forth that Innscor faces, we'll see that for a heavy asset-rich company in their scale, they won't really produce those exceptional results quickly whilst they were still doing capex and trying to maintain their base. So this was actually a good result with the current macroeconomic environment climate. Then we go to the liabilities, which grew at 16% versus equity, which grew at 9%. So this speaks to more leverage in it's intentional and strategic, yes, but debt was used to fund expansion, support working capital, and it makes sense if the returns will be greater than the cost of debt, which I'm very optimistic about. And business prefer USD debt to hedge against currency risk and also amplify returns when margins improve. So the momentum is being kept here. So I'm confident that they are working towards a strategy where they will have a higher return than the cost of debt.
Okay. And looking at the income statement, one of the most important line item for investors, that's the EPS. And we saw it, growing by 66%. And just out of concern, how much of this is cyclical? Is it sustainable in your view?
I think this is not cyclical in my view. This is sustainable. What we are seeing here is after a major period of capital investment, Innscor is just starting to sweat its assets at the moment. So these are the results of them now pushing to sweat those capital expenditures they did, those assets they invested in. They're now trying to bring out the best in them. So I think we are going to see another improvement in the earnings per share. Maybe come full year, maybe we'll get a 70-80% rise.
Okay. Then just the last question, then we wrap up on Innscor and look at Axia. We saw the dividend, it grew by 62%. But if you want to look at the current yield of Innscor, that's 30%. And also, if you have to look at its price earnings, it's trading at a multiple of 13 times. So we just want to hear your views, to the shareholders. Do you foresee any upside potential for the near to medium term for Innscor's, whether on a capital appreciation point of view or on an income play that's looking at the yield?
I think we're going to see an improvement in its price. Okay. I think a company like Innscor should be trading at a multiple of around 15 times, 16 times its earnings.
Okay.
So at the moment, I think the value is still significantly lower. And with its earning potential of earning over $1 billion in revenue, I think it's poised to re-rate. We are going to see a re-rate story. I would factor in maybe a 25% upside on the current price.
Interesting. And you, Jabu?
Yeah, I think, as I have said before when I was commenting on assets, Zimbabwe macro risk keeps valuation. So Innscor is actually a company that is defying this. So it will start with a low yield on dividend, and it grows as the income play continues with the momentum. So the benefits will be seen, but not now in the short term.
All right. There you have it, our viewers. What's your thoughts? Kindly share your views so that we get to hear what your sentiments also are as far as Innscor is concerned. Let's move to Axia. Now, we saw revenue for Axia. It grew by 22% to 122 million. And it was largely volume driven. We saw the group deliberately employing aggressive pricing strategies to combat competition from the informal sector. So the first question is, how sustainable is this growth? Is this growth if pricing remains aggressive?
To look at this phenomena first, we'll see that the growth was volume driven and price cuts, as you said, it was deliberate. But it was more important in that Axia wanted to, there's a informal and formal sector fight for customers. So for a large group like them, sometimes you have to cut on your prices and margins to win the loyalty of customers. So this growth from cheaper pricing, and it shows that the market is now not looking only at formal providers, and it shows that in the long term they need another key strategy for customer loyalty, maybe credit offerings, buy now pay later partnerships, because the current growth is real but very fragile. You cannot win a prize war. Like in economics, everyone knows you can never win a prize war.
Yeah. Okay. And as a result, we saw the gross profit margin declining to 30.8 from 34.1. So the question might be, at what point do you think the management might need then to raise prices, perhaps if the competition from the informal sector continues like this?
So I think this question is broadly suited. What is government going to do about the informal sector?
Okay.
That is the only trigger that will actually make Innscor, Axia rather,
yes,
increase its prices. Because if government intervenes in the informal sector, that is, they put more controls, there is heavy regulation to try and counterfeit, to try and
to cushion the formal players,
and also stop the counterfeit goods that are coming through our borders,
yes,
put tighter border controls. That will mean that the formal sector players are going to see an increasement in traffic, an increase in traffic rather, to their shops. And at that point, when they actually have control over the market, it's the only point where they can increase their prices. Because at the moment, they do not have control. The customers have bargaining power. Them as a supplier, their bargaining power is very limited.
Okay.
So, and as we know, Zimbabweans are very sensitive to any price movement.
Sure.
So we are always looking for the cheapest price. Even at times we go to an extra mile and compromise on quality. So this will only depend on what government is doing to counter the informal sector.
As always, how Axia is going to respond, because at some point from the analyst briefing, I mean, we heard the management saying they will do their level best to ensure quality, but pricing competitively from the informal sector.
But like Java alluded, you cannot win a prize war. That one is a very difficult one.
Okay, so maybe a follow-up question then is, had they not employed these aggressive pricing strategies, in your view, what were the margins likely to look like? EBITDA margins?
I think we would have witnessed EBITDA margins around 16 percent, between 16 to 20%. But then we noticed that they to actually go on to do a deliberate attempt to actually say, let's lower our prices and try to push volumes. So it was now a volume play. At lower price levels, lower margins, but we try and counteract that with pushing volumes in the market.
Okay, now looking at Axia, maybe for the benefit of our audience as well, it has got also 3 main SBUs. Then we're looking at TV, Sales and Home, Transav, and Distribution Group Africa, which is, operational in 3 countries. That's Zimbabwe, that's Zambia, right, and that's Malawi. So looking at DGA Zimbabwe, we saw that, it posted strong revenue growth, but the EBITDA dropped significantly. So I'd like to hear from you. Is this purely due to the credit provisions that we saw the group declaring, or structural cost pressures in this sector, as we have seen that it's also one of the sectors that is likely, to be affected by informal players?
Yeah, you're very right. One of the reasons why DGA revenue was up and the EBITDA was down was due to credit losses as customers are struggling, and there's also a some cost pressures as rent, wages and logistics are going up. We are also seeing fuel prices is going up with the current Middle East crisis, and also competitive pricing by trying to offer goods at such prices that would make people not opt for the informal sector. So it's not fully structural but partially systematic to the economy. But I'm very confident and optimistic that in the long run, with brand differentiation, they can be able to offer their high quality products at a price that is good for the business.
Okay. Ian talked about the cash conversion ratio for Innscor, and I want to talk also about the cash conversion ratio for Axia. We saw it improving from around 24% to 77%.
Yeah.
How sustainable is this level going forward?
It's big improvement, as you are saying, from 23% to over 75%. We are seeing better working capital management. We are seeing delayed supplier repayments. So not fully sustainable at that level, but it can stabilize the business as it deals with outside pressures within their business model and other things, but we will normalize to 50 to 60% if all factors are in place.
Oh, okay. Ian, let's look at the risk as far as the currency front is concerned. If we were to, backtrack a little bit, in 2024, when ZiG was devalued in September, we saw Axia, incurring financial losses of around 2.3 million. In its latest half-year financials, we saw the top line of DGA Malawi. It was down by 12% despite a 24% volume increase. That's a currency at play there. And also in South Africa, when the rand strengthened, we saw the group incurring financial losses as well of around 646,000. So how exposed is Axia to currency risk in your view?
I think, it's self-explanatory in a way. So you see that as long as there are currency movements in either Malawi, Zimbabwe or South Africa, DGA Africa incurs, let's say, a loss or there is a currency valuation gain one way or the other.
Okay.
Well, this is because DG Africa is pushes their consumer goods mostly. So it's the one that was pushing Unilever brands into formal markets. So the problem mainly is they are pushing into the formal sector.
Okay.
The formal sector doesn't react quickly to changes in the macroeconomic environment. So you cannot wake up and just change prices. There's a lag to that. So that sector is it's hard to cushion it from currency dynamics.
Okay.
I think it's a homework for management to try and find a way on how they can reduce their exposure to
Perhaps
currency
to-
fluctuations. Yes.
And perhaps not selling in local currency in some of their products.
That you can only do in Zimbabwe, because DG Zimbabwe is the only unit that can maybe say we will try to sell our goods in USD and reduce exposure to the ZiG. But at the moment, I think also they have benefited in Zimbabwe because of the stability. In the last 6 months, we have noticed that ZiG inflation was below 1% month on month. Also on the USD front, it was below 1% month on month. So, and the currency was relatively stable, with the exchange rate premium reducing to around 21%.
Yeah, sure.
Yeah. So they are okay when we look at DG Zimbabwe. But when you look at exposures in Malawi and South Africa, there's still a problem there, and I think management has to figure out
How best they can deal with
they
it.
can deal with that. Yeah.
Interesting. And the last question, Jabo, if we are to look at the current dividend yield, Axia declared a dividend of 0.2 US cents, it's 2.7%. And it's trading at a PE multiple of 11 times. In your view, do you see any upside potential for the counter, or downside, or you remain neutral?
Yeah, I see some yield there, but I feel like there's a value trap risk unless the margins increases. So the other issues that we're talking about on dealing with brand differentiation and making sure that they're able to fight off competition from the informal sector and so forth are the things that will, and the trade-off of sacrificing volume, like where they chose volume to increase volume and lower price. So this all plays to the end, to the end result in a valuation or a yield that might be grow for them. So I think if margins increases, they will be able to offer more yield.
All right. Well, that's all the time that we have for you. Gents, thank you so much for having me on set.
Yeah,
You're
it's a
most
pleasure.
welcome. It's a pleasure.
Right. Viewers, until next time, stay invested, stay informed, and keep your eyes on the market. It's bye for now.